changes in TDS and TCS relating to assessment year 2021 and 21-22. We have speaker, resource person, CATG Suresh sir from Chennai. I request our chairman to welcome our resource person and all the participants to this seminar.
Very respected resource person, CATG Suresh sir, senior members, colleagues and friends in profession, and my colleagues in Managing Committee of Ernakulam branch of ICAI. Good afternoon to all of you. Welcome to the virtual webinar on latest changes in TDS and TCS relating to assessment years 2021 and 21-22, organized by Ernakulam branch of ICAI. As you may be knowing, during the year, the government has brought in several changes and amendments in income tax laws and rules. Some of the changes were to help the assessees during the COVID-19 pandemic, and some others were to bring more check and control and transparency in financial transactions. One of the most important change brought in was relating to additions and amendments to the provisions of TDS and TCS, which were effective from October 1st, 2020, relating to assessment year 21-22. Today, our resource person will cover these important changes and amendments to TDS and TCS provisions relating to the assessment years 2021 and 21-22, and enlighten us with its impact also. I'm not going detail into it because the resource person is Suresh sir is here with us. To lead the discussion today, we have with us, as I mentioned, the very knowledgeable TG Suresh sir, who is well known to many of you present here today. He is a very close friend of ICAI Ernakulam branch. He used to take classes and even for faculties, came as faculty for members seminar also. And we are very happy to have Suresh sir with us today. On behalf of Ernakulam branch of ICAI, I extend a cordial welcome to CATG Suresh sir, the resource person to this webinar. Welcome, sir.
Thank you, thank you. So it's always been a pleasure to be with Ernakulam branch. So
thank you, sir. Let me welcome all of my fellow colleagues in Managing Committee. Immediate past Chairman C.S. Srinivasan, Vice Chairman Ranjit Warrior, Secretary C.K.B. Jose, Treasurer Deepa Varghese, Sikasa Chairman Alan Joseph, Study Circle Coordinator Salim, everyone to this webinar. Finally, it is my pleasure to welcome each and every one of our senior members, colleagues and friends in profession attending to this virtual meeting. Yesterday, I didn't mention everything. Today also I want to tell something because you may please note that unless you are personally present here, the CPE credit will not be available to you. Yesterday we had more than 160 registration and 100 only joined for this webinar. And today also we have got 150 plus registration, and gradually members are joining. But see that you join and be here. Without attending the seminar, you will not be able to. You will not be eligible to get this CPE credit. Please note that, and please pass on the information to your friends also who registered for this meeting but not attending this meeting. Again, for any queries or questions, use the Q&A box, not the chat box. Chat box should be used for your chats and comments only. And see that you post your queries in the Q&A box so that Suresh sir will be able to identify it easily and answer your question. That's all I want to tell you. Once again, wish you all have a wonderful learning time here today. Thank you very much for your patient listening. Or to Jose for further proceedings, please.
Thank you, Chairman C. Roy Varghese. Now may I request our treasurer of the branch, C. Deepa Varghese, to introduce our resource person, C. TG Suresh.
Thank you, Joseph. Good afternoon, everybody. It's my pleasure to introduce today's speaker, CATG Suresh, a close friend of our branch. CATG Suresh completed his graduation in commerce before going on to qualifying as a chartered accountant in 1988 and is a pioneer in setting up the firm Messrs. Balaji and Suresh Chartered Accountants. He also did his CMA and company secretaryship. CATG Suresh is a leading faculty in Chennai in domestic taxation and international taxation, finance management, cost accounting, and financial accounting for almost 30 years now. He is also a visiting faculty for taxation at the regional councils of ICAI at Chennai, Bangalore, Mysore, Ernakulam, and Cuttack. He has authored many books, is a regular paper presenter, and publishes articles in both online and offline mode. CATG Suresh is a member of various committees, including the Direct Taxation, International Taxation, and is a co-opted member of various committees of ICAI. He is a winner of National Award from the Capital Foundation Society, New Delhi, from the Union Law Minister himself. With these words, may I request CATG Suresh to kindly share his knowledge on the latest changes in TDS and TCS relating to assessment year 2021 and 21-22. Over to you, sir.
Thank you, Chairman. Thank you all. It's always been a great pleasure to be here. So though I'm not physically present, it's as good as being physically present. So before I start, again, my humble request to all of you is that stay safe, because you can work by staying safe, because having has personally experienced this thing, so the pain of it is something which definitely I know. This is something where this particular COVID, we don't know whether it's for some people it's got a very different experience, but of course it's a different experience for the thing. But the best course of action, as I was also talking to the chairman also, better as far as possible how we can prevent ourselves. That is more important. We can always, anything we need to handle, but prevention is always a better choice. So I thank you. So in fact, this is a wonderful topic which was selected. So in fact, even a lot of other branches are also asking, but I'm telling them so have something different, because so I don't want a situation where if you give a different topic, at least I can enrich my knowledge in different areas. Though it is easy for me to go in this is once prepared is enough, but still I want to explore in different areas. I really thank the Ernakulam branch for make me go deeper into this particular section, because in these kind of situations really help us to go deeper. And also a lot of senior members are here, so your input will also help me in enriching my knowledge. So more than me sharing the knowledge, it's not only sharing but also learning in the process. It's a very interesting provisions as we talk about a situation of ease of compliance and ease of doing business and so on and so forth. So one may always ask the logic of, with such a thought process of the government, whether we could have been better off without these kind of provisions. That's an important question. So much of complications, so much of controversies. Whether this could have been achieved through some other route, it's a question. I think the lawmakers must seriously think on this particular point. And one side, the government wants to be very keen on the ease of doing business, wants the compliance to be lesser. But on another side, the provisions like 206C, 1H are something which are they going to defeat the purpose? So I'll just leave it to the wisdom all of you. As I said, I will share my thoughts on that and then possibly take your inputs also in the process. So since the topic given to me is the TCS and TDS changes for financial year 2021 and 1920, subject to time permitting, I will try to cover even the TDS changes which were made in financial 1920, which quite a lot of changes were made in 1920 when we carry out our tax audit obligations, and that those amendments will also help. I think that could be the intent of the chairman specifically putting this topic as both for 2021 and 1920. One is the futuristic, and other one is the one which is the year which is concluded, which also has to be knowledgeable on these points. So first I'll go to the topic of the day, or the hot topic going on in the country on the TCS part of it. I think most of us would have got a lot of queries and a lot of questions from the client. In fact, the board itself came out with some kind of a clarification only towards the end of September or close to the end of September. Of course, that's the normal practice. And they always come out late and they want us to discharge on time. That anomaly always baffles me. But a lot of my friends and the clients in the industry seem to be not really prepared at all. In fact, they were a bit shocked when I was trying to explain the complexities of this provision. So, as we all know that the TDS and TCS provisions are specifically there in Chapter 17 of the Income Tax Act. So, basically, in a country like India, the TDS and TCS is what the government believes which will make the collection of tax more easier than an advance tax route or a self-assessment tax route, because most of us always have the question, and why should I pay tax? So when yesterday there was a bit of rain in Chennai, so immediately a lot of the roads are submerged with water. It's not a great rainfall and all, but still. So then many people started, what is the roads, where is the water, all the stuff. There's always been a question on why should I pay tax. It's always been in the minds of the many people, rightly or wrongly. All of us would have learned that there is nothing in return in a tax. That's what there is no quid pro quo. But most people do not realize this particular point, and that's one of the reasons why TDS and the expanded scope of TCS now is where the government strongly relies upon for the purpose of collection of tax, where they want to be close to 60% of the tax collected, they want to be through this mechanism. So as regards the specifics of TCS, which was first introduced through Finance Act of 1988, the scope of TCS was substantially enlarged by the Finance Act of 2020. So therefore, like the terms, it's like 2.0 seems to be very famous terms. So therefore, I'm just also trying to borrow that term again. So we can call it as TCS 2.0 or TCS 2020. So comes into force on 1st October 2020. Some aspects of the transaction cannot be challenged on the grounds it is ultra-vires the constitution. That is something which generally we as chartered accountants also should think in terms of. Certain clarifications issued by the board, as usual, only adds more to the confusions than the clarification. So therefore, all of us should come together through the institutions, represent the government to remove these ambiguities, so that the overall vision of the government of relatively less litigation is achieved. So therefore, on one side, we cannot have a situation where we have some faceless assessment, faceless appeals, and when we want mechanisms to reduce litigations. On another side, create provisions which leads to that. So as already specified briefly, the TCS was introduced by virtue of Section 206C of the Income Tax Act, by Finance Act of number 88. So it was introduced as a consequence of a presumptive income section of 44AC, so which is basically for just like your presumptive income under 44AD. 44AC is one of the presumptive income sections at that point of time for trading in certain goods. So in order to comply with the presumptive income at that point of time, so they wanted the concept of at the time of sale, collect the tax as a percentage. Unlike a tax deducted at source, where the person making the payment deducts the tax before making the payment, here the person collecting, the recipient, is actually one over and above the sales in GST, is also required to collect the TCS. So basically, the whole idea which the memorandum was trying to explain. So in the case of sale of liquor, scrap, etc., the department was saying it's finding it difficult to collect the tax. Most of the transaction happens in cash. It's very difficult to track the transaction. So therefore, we want to go through the TCS route, and there is also they sent 44AC and 206C are basically introduced to avoid the large-scale tax evasion. So the Supreme Court has also upheld in the case of Union of India versus Sannyasi Rao that the provisions of 206C, which is basically like an advance tax, therefore it cannot be challenged on the account of constitutional validity. So therefore, that's constitutionally valid. But though the constitutional validity of 206C has been held valid by the Supreme Court, but the point we need to understand here is the context of, or the way in which the current some of the sections of 206C were introduced. Still, there is a scope available for challenging them on the basis of a constitutional validity. So, so the scope of the TCS has been further widened by Finance Act of number 2004. So though 44AC was removed, still 206C continued. That's possibly all of you may be aware of. Finance Act 2012 further widened the scope of TCS to include even sale of jewelry or bullion in cash. A further scope of the TCS has been widened by 2016 by covering the sale of motor vehicles value in excess of 10 lakhs. So now the scope of the TCS is now going to be further widened by 2020. So where the TCS on foreign remittances through liberalized remittance scheme or LRS, overseas tour packages, as well as the sale of goods. So three major areas have been brought under the ambit of TCS. So as like what you have in 206AA in the Income Tax Act, which tries to ensure that people do get the PAN number or do have the Aadhaar number. So a higher rate of TDS is provided there. So either the rate specified in the section or 20% is what 206AA specifically provides, the event of not having PAN or Aadhaar. Similar discouragement is also there in TCS. So in the event of non-furnishing of PAN or Aadhaar, so they will be subject to a high rate of TCS. So the basic idea seems to be an anti-abuse provision. So the main objective is to widen the tax base and also to leave some trail and curb the cash transactions. So we are just trying to make an attempt to just widen the debate, just find out what else we can learn from this. I'll just skip this except for the last three where you have, so just given you the overall TCS rate of all the sections put together. But what we are really concerned now is only the 11, 12 and 13. The sale of goods more than 50 lakhs by Finance Act of 2020 is going to be 0.1% or 1% in the case of non-PAN or Aadhaar cases. So when you have the case of liberalized remittance scheme of LRS, it's going to be the rate of 5%. And you also have an overseas tour program package, and it's going to be at the rate of 5%. So we're going to have three different rates, except in the case of non-PAN, non-Aadhaar cases, 0.1%, 5%, and 5%. So first we'll so the reduced rate and impact of non-furnishing PAN. So we'll come to this a little bit later. So the changes made in 206C, basically you have two sections introduced, 206(1)G for the foreign remittances and 206(1)H for sale of goods. So 1G is in turn, you have two more subclasses, A and B, one covering LRS, such a limited remittance, liberalized remittance scheme, or the purchase of foreign tour package. So this is broadly the area which we're going to focus in today's session. In the TCS, of course, we'll have sections covering TDS also will be focused. So first we'll move on to the TCS on foreign remittances, 206(1)G. So the reasons for introduction, as explained by the memorandum, the section was introduced to widen and deepen the tax base. So $14 billion sent out of India through LRS in the previous year 18-19 as compared to $1 billion in 19. So that means we have almost gone up by 14 times in about a 10 years period of time. Just $14 billion is a huge amount going out of India through an LRS route. So an internal sample survey out of 5,026 cases of foreign remittances close to 1807 people did not file the return of income. So which the government feels 5,026, which just like the samples taken for COVID. So it's a huge 1807 out of 5026. That seems to be high percentage, is it? So enforcement director or TDS also stated this was used by the traders to perform hawala transactions. So therefore, what the government says, will use the TCS route for a better tracking of these circumstances. So therefore, it is not a measure of collecting the revenue. The measure seems to be more to keep track of the transactions. More importantly, to prevent the hawala transactions, and also at the beginning, so widen and deepen the tax base. Well, that's a reason which is given by them. So what is this 1G is saying? So every person being an authorized dealer who receives an amount for remittance out of India from a buyer, being a person remitting such amount out of India under the liberalized remittance scheme of the Reserve Bank of India. So in order to apply this section, the person who received this amount must be an authorized dealer. So he is in receipt of amount of remittances outside India, and that amount is received from buyer, who is a person remitting such amount under the liberalized remittance scheme of RBI. So we'll just look at a few points about what are the purpose for which LRS can be used, which will be of some help in understanding this section. So the rate of TCS is going to be, if it is education loan as defined in section ETE, it's going to be a slightly reduced rate has been given, which is 1.5% of the amount if it in excess of 7 lakhs. For any other purpose, you will have a 5% of the amount exceeding 7 lakhs. So for educational loan, a reduced rate has been prescribed, this 1.5%. In any other case, it's going to be 5%. So the timing of reduction at the time of debiting the amount payable or the time of receipt of such amount, whichever is going to be earlier. So in the event of buyer being subject to withholding tax, in fact, if the person is subject to deduction of TDS under Chapter 17B of the Income Tax Act, then the section will not apply. Similarly, if the buyer is a central government or a state government or an embassy or high commission or legation or a commission or a consulate or a trade representation of a foreign state, or a local authority as defined in section 1020, or in their person as a central government in the official gazette, specified for this purpose subject to the conditions as may be specified. Similarly, if your the TCS on overseas tour program or package is dealt with by 206C 1GB. So it's applicable to a seller of an overseas tour program package who receives any amount from a buyer, being the person who purchases such package. So interestingly, if you look at the rate of TCS, it's going to be 5% of the amount, and there is no threshold limit seems to be specified here. So the overseas tour program package here means a tour package which offers visit to a country or countries or a territory or territories outside India, and includes expenses for travel or a hotel stay or boarding or lodging or any other expenditure of similar nature. I don't know what is the timing of the introducing this section. I doubt how many people are going to take up this now. So therefore, maybe sometimes you introduce the right section at the wrong time. So now the purpose of this section itself is very, very few people are going to actually do this. And therefore, the effectiveness of this section might have dramatically come down. Of course, the LRS is something which is very key. That's why. So we'll take a brief snapshot of the LRS. So the RBS introduced the limited remittance scheme by circular number 64 dated 4th February 2004. The LRS is made under the FEMA to allow all resident individuals, including minors, are allowed to freely remit up to $250,000 per financial year. So as mentioned already, the scheme was introduced on 4th February 2004 with a limit of USD 25,000, which has gradually been increased over a period of time to $250,000. So these are some of the purpose for which you can use the LRS. private visit to any country except Bhutan and Nepal, gift or donation, going abroad for employment, immigration, maintenance of close relatives abroad, so travel for business or attending a conference, a specialized training, etc. So expenses in connection with the medical treatment abroad, studies abroad, and any other current account transaction which is not covered. So look at the few interesting points here. If you are making a gift to a relative under the liberal scheme, or if you are remitting for maintenance of close relatives abroad, so what is going to be the income involved here? So these are purely personal in nature. So where is the question of the amount being collected towards income tax? So if you see this section, so we are going to collect this amount for a purpose as towards the income tax. So where is the taxation involved in the case of a gift or donation, especially to a relative? So in case of this gift is made to a non-relative consequent to the introduction of 918, maybe that gift becomes taxable in India. So when the gift or donation, if it is not taxable in India, when the transaction itself is not taxable, when the transaction itself is not a commercial transaction, when the transaction itself is a personal transaction, it's a non-commercial transaction, should that be subject to TCS? Whether such levy cannot be challenged on the basis of a constitutional validity. So can we file a writ petition? So that is something which I want to bring to your light. So let's just go back to the very famous decision in the case of 195. So G India, very popular case, Transmission India. So where it was categorically held by the Supreme Court, if the payment is made to a non-resident, will be subject to withholding tax only when such payments are chargeable to tax in India as per Section 5 and Section 9. So if it is a non-resident company having no P in India, nor having any business connection in India, the income on this account, even if it is paid, not taxable in India. So once the income is not taxable in India, the question which arises now whether there can be a TDS in the 195, over which the Supreme Court said the question of deducting tax does not arise. There was a very interesting issue consequent to the Karnataka High Court judgment in the case of Samsung. That you have to always deduct TDS and you cannot decide whether income is chargeable tax. That decision was reversed by the Supreme Court in G India. Now let's look at what is the basic principle upheld by the Supreme Court in that particular case. Is if a commercial transaction not taxable in India, there is no need to impose any tax on such transaction at its source. Though the tax deducted as source and tax collection as source are different, the only major difference in the case of a TDS is the person who's making the payment deducts tax toward the income, whereas in the case of a TCS, it's a person who's in a receipt of the income collects the same. So that's one broad difference. But the only important issue is that when the income itself is not taxable, is it fair? Is it logical? Is it right to collect the TCS? That is a very important question. So therefore, there is a possibility of, just like we filed some writ petitions for the extension of a due date, which I feel that this particular year, I think waiting till 23rd of October, considering this kind of an exceptional situation, looks highly logical. See, maybe some other year, maybe they're justified in not announcing the extension of the due date. But considering this being extraordinary year, considering the amount of issues faced across the country from lockdown to many people been affected by this, so one is not able to understand the logic of why the extension due date is taking so much time to be announced, and we are already on 23rd of October. Now, this is where sometimes seems to be some of the legislations and some of these things looks slightly illogical when compared to the government's thought process. Is there a disconnect? That's one question. Now, so here look at in the case of a gift under the liberal scheme, the gift given by a relative is not a commercial transaction. It is a non-taxable transaction also. Assuming that my brother is studying outside India, or my son is studying outside India, and I make a remittance to him under the liberalized remittance scheme. So this is only, it's not a commercial transaction. this transaction is also not going to result in any tax incidence in India. So where is the question of collecting 5% of the amount remitted by me towards a tax? And they've also clarified that there is also a specific section 206C4 specifically provides whatever tax collected here is to be treated like a prepaid taxes, and it can be adjusted against my normal tax payable. Now, so the question is basically this has been eventually treated by subsection 4 as an advance tax paid by me, but is the transaction subject to tax? Now, what is the treatment of such transaction in India? So if I make a remittances in India to my relative in India, it's exempt from tax and there is no levy of TCS. But the same thing I'm doing to my relatives located outside India, whether that concept does it change? So the basically 56(2)(10) specifically exempts any gift made to a relative whether they are in India or outside India. So the concept is not going to change in this particular case. Therefore, attracting blanketly for all LRS a TCS at the rate of 5% appears to be completely illogical, completely something which the government is better off to reverse, because the Central Board of Trade Taxes has been given powers to notify the transactions which are not subject to TCS. I think it's definitely they should quickly act on this particular point. Take a slightly different point is what is the concept of LRS. The leveraged remittance scheme itself is to remit up to $250,000 without a burden of excessive compliance. That is the basic purpose. So why should an RBI come out with this particular point up to $250,000? They come back and say, guys, you don't have to have such big complaints. So up to a threshold limit, the whole concept of under the FEMA, the RBI itself being a regulator feels that so we should have a more freer business, a more freer environment. So there should be a complaints-less remittances, and that is why the scheme is introduced. But when you are introducing a complaints for this, you are adding something which is not even required by the concerned law. So which is inconsistent with the government policy, which is inconsistent with the policy of the Reserve Bank of India. So when definitely all of you will agree with me, FEMA is a more, I would say, a law which is to be more viewed as in terms of the violations, has to be more seriously than income tax. If that particular law itself gives you some kind of a relaxation through an income tax act, can you just curb it? Can you just make it more harsher? That is the question. So therefore, this inconsistency of the law should be avoided, and therefore it's highly suggested the board comes out with a clear clarification that the transaction not taxable should be kept outside the purview of the TCS. So again, as I said, the various equation of so the question of how do you adjust the tax, assuming that I don't have any tax in this year, I'm just only making a remittance. I'm a retired person. I'm just only making a remittance to my son studying abroad outside India and don't have a tax payable in India. So what is that I'm going to do with the tax? And that means you are taking away the money because it's this particular remittance is not going to be subject to tax in India. So therefore, you want me to adjust for some other income of mine on a transaction not subject to tax. That means you are trying to take away a certain portion of my money. Let's assume I remit 50 lakhs. You take away 5% or 2.5 lakhs from my mean, for which I have to file that. I sent in the month of April. I can only claim the credit only when I file the tax return the next year, even if I don't have a taxable income. I think therefore, this is something where my right to enjoy my property, right to enjoy my value, which is enshrined in the Constitution, Article 300A, has been taken away by this provision. So therefore, in my view, this LRS tax return, especially for a gift and certain transaction not subject tax, is really something which the government should roll it back. The CBDT has been given the powers to do that. I think they should exercise this power immediately without waiting, just like they've been doing for the extension of due date for the tax audit. So on the section which I think all of us will be more waiting and more, I think, because it's going to affect us more than the previous one. The TCS on sale of goods, 206C, 1H. So what is this section? Let's try to, I've just tried to split the section for us to understand it easily. Every person being a seller who receives any amount as a consideration for sale of goods exceeding 50 lakhs in any previous year, other than goods exported out of India or the goods which are covered in 2061, 1F or 1G, shall at the time of receipt of such amount collect from the buyer 0.1% of the sale consideration exceeding 50 lakh rupees as income tax. So therefore, in order to apply 206C 1H, every person, so therefore it does not exclude anybody. Maybe some exceptions we'll see in the next page. That's more about central government, state government, blah, blah. Similar to that of, so what we discussed in 206 1G. A person has to be a seller and who receives any amount as consideration for sale of goods exceeding 50 lakhs in any previous year. So therefore, qua buyer, the amount of consideration you receive for sale of goods, if you just closely note that particular point, it covers only sale of goods. It's not covering the sale of services. So it only covers sale of goods exceeding 50 lakhs in any previous year. So other than the goods which are exported out of India, which initially this export out of India was not there. So luckily that was brought, plus goods covered in 2061, 1 of 1G, which separately provide for TCS rate in those sections. So therefore they're excluding, so that you are not being subject to TCS in the multiple sections, or you need not have to worry about which are the two sections you should apply. For example, sale of motor vehicles comes under 1F, so that they don't want a situation where you have to be confused between 1F or 1H. But the TCS is required, unlike the other section 1G, it is required only at the time of receipt of such amount. And the rate is 0.1% of the sale consideration exceeding 50 lakhs as income tax. Suppose if I'm going to receive 51 lakhs, on the reading of this section, it appears you have to collect only 0.1% of 1 lakh only. However, if the PAN or Aadhaar number is not furnished, then the rate of TCS will be at the rate of 1%. This is provided by proviso to 206C 1H. I just want you to observe this particular point. The rate of 1% is provided by the proviso. So in case the provisions of 1H require collection of tax at source during the period commencing from 14th day of May 2020 to 31st day of March 2021, then notwithstanding anything contained in these subsections, the collection of tax shall be made at the rate being 3/4 of the rate specified in these subsections. So why I was trying to mention this particular point, that if the PAN or Aadhaar number is not furnished, then the rate of TCS will be 1%, because we all know the rate of TDS is going to be 20% if PAN or Aadhaar number is there. It is governed by a different section. It's governed by 206AA. For example, 194C provides for a TDS of 1% or 2%. But if you don't furnish a PAN number, 194C does not say that 1% or 2% will become 20%. Right? That's one important point I want you to observe here. So it is not 194C proviso which is saying that the rate will be 20%. That is given by a separate section 206AA. That section starts with notwithstanding anything contained anywhere in the Income Tax Act. It will be at the higher of rates in force, the rate mentioned in the section, or 20%. But here in 206C 1H you have a proviso which says that the 0.1% shall be substituted by 1% if PAN or Aadhaar number is not furnished. Now, this is a very interesting point. All of you will be aware of. On 13th of May, there was a press release which specifically said from 14th of May, this is a part of stimulus measure due to COVID. So in order to increase the cash flow in the hands of the people, So 13th May 2020 press release was specifying that in case of any reduction happening between 14th of May to 31st of March, then so we'll have 70%. So one important difference what we are talking about, the higher rate of TDS is governed by a separate section 206 AA, whereas the higher rate for TCS is actually governed by 206C itself. There is no separate section for providing for that. So this board circular, this press meet very interestingly clarified. They gave a table and they also clarified that the 75% of the rates will not apply in case where PAN number or Aadhaar number is not furnished. Now, as regards to the TDS, therefore it's quite obvious for 206 AA, you cannot apply 70% or 20%. Can I apply 75% of 1% in the case of TCS? That is one important point. So the elaborate discussion I'm trying to make, I just want you to just understand the difference between TDS provisions where the higher rate is given by a completely different section 206 AA after all the sections are over, whereas in the case of 206 C1H, it is there in the section itself as by way of a proviso. So whether the press release will continue to apply or can we take a stand that even in 1% cases, there's 3/4 rate or 70% of 1% apply. So we'll just keep this issue a little bit later, but I just want to trigger this particular point. So as per the board circular 17/2020, transactions in electricity, renewable energy certificates and energy saving certificates traded through power exchanges are not subject to TCS. So power exchanges, stock exchanges and commodity exchanges, any transaction in power, stock and commodity exchanges have been kept outside the purview of TCS. So just to give a highlight of the issues which we are going to consider, I just want to say the third bullet point. Who receives any amount as a consideration for a sale of goods exceeding 50 lakhs any previous year. Therefore, in order to apply 206(1)(h), the seller must be in receipt of the consideration for sale of goods exceeding 50 lakhs. So I will elaborate this, but I just wanted to bring to your attention. Section gets triggered if you receive any amount as a consideration for sale of goods. Therefore, in order to apply 206(1)(h), you must be in receipt of a consideration for sale of goods. If you are not in receipt of the consideration of sale of goods exceeding 50 lakhs, will the section apply? I make a sale above 50 lakhs, whether that triggers TCS or the receipt of the consideration of sale of goods trigger. So that is one point which I want to bring it to your attention when we are seeing the basic provisos of the section. So again, other than goods exported out of India, if you make a sale to AZZ, you can consider it as a deemed export, but for the purposes of 206(1)(h), it will not be considered as export, because if you see the language, it very clearly specified it must be exported out of India. So when you are selling to an SEZ, it is only a deemed export. You are not trying to export it outside India. Therefore, the TCS will apply on sale to SEZ also. So who is a seller? Who is a buyer? So that has also been defined in the section. Because in order to attract the section, as once again if you see, a person must be a seller and he must be receiving any amount as a consideration for sale of goods exceeding 50 lakhs in a previous year from a buyer. So therefore, the seller and buyer are very crucial here. Seller means a person whose total sales, gross receipts or turnover from the business carried on by him exceed 10 crore rupees during the financial year immediately preceding the financial year in which the sale of goods is carried out. So total sales, gross receipts or turnover from the business carried on by him exceed 10 crore rupees during the financial year immediately preceding the financial year in which a sale of goods is carried out. So therefore, the first point to apply the section came into effect on 1st October 2020. So therefore, what we need to check in your financial year 1920, what is your turnover? So if your turnover does not exceed 10 crores, the equation of applying TCS does not arise. So therefore, the first condition, your sales in the financial year 1920 should have exceeded 10 crores. There comes a very interesting challenge, how to consider the turnover. Should I have to include in the turnover GST, or the turnover here or the sales here or the gross sales here excludes GST? Another interesting controversy they have created here, whose total sales, gross receipts or turnover from the business. Though the section is applicable only for receipt of consideration for sale of goods, for applicability to the section for some very strange reason. So look at the way in which they worded the section. Sales, gross receipts or turnover from business carried on by him should exceed 10 crores during the financial year, immediately preceding the financial year in which the sale of goods is carried out. So therefore, if I carry out the sale of goods in financial year 2021, I have to consider the turnover of the financial year, but turnover from what? Business. So therefore, one logical question arises, for this 10 crores, should I have to include only the turnover from goods? But if you see the wording section, it talks about turnover from the business. So whether the turnover is inclusive of GST or not. So whether services will also be considered. Whether interest income which are earned by me in the normal course of business, whether that to be considered. So likewise, they have some opening up a lot of issues here for us to debate. Not being a person as a central government by notification, the official gazette specified for this purpose, subject to such conditions as may be specified. So therefore, central government can notify and exempt from the definition of seller, subject to conditions they may specify. So buyer means a person who purchases any goods, but does not include like what we have already seen in the case of 1G. So we find 1, 2, 3, 4 are already there in 6. First, second, third, fourth, and 6 are also there in 1G. So only one category which is over and above what is there in 1G is a person importing goods. The person imports goods. He is not a buyer. So therefore, a buyer means who purchases any goods, but does not include a person importing goods. So therefore, obviously, what they're trying is quite logical, because if I'm going to import goods from outside India, the TCS is going to be collected by the seller. So seller is sitting outside India. He has to collect the TCS, and then he should obtain the TAN number, and then you also have to make a remittance. It's going to be a huge compliance burden for somebody who is sitting outside India, because in an import, the seller is sitting outside India. It is going to be very difficult for him to comply with these provisions. I think therefore, logically and rightly, so this has been excluded. So with this background, we'll just try to analyze few issues which I've come to my notice. And so it just looks like it's only some 4 or 5 lines. Maybe if you want every person, just a small 2 words, being a seller, then 1 line for receives an amount. It looks like a very, very small section, but when you just go deeper, you find quite a lot of exciting issues are there. So therefore, a couple of issues which I'm just trying to bring it here, whether the section will apply for sales made before 1st October 2020, whether the amount received prior to 1st October 2020 be considered for the purpose of limit of 50 lakhs. So whether you have to collect the TCS on the entire amount or only the amount in excess of 50 lakhs. Should we have to include the GST for the determination of turnover or gross receipts? So whether GST to be considered for the purpose of TCS, whether TCS should be included in the invoice, or can you raise a separate debit note? Assuming you go to the route of raising the debit note, whether GST should be levied on the debit note. So whether sale of services covered by this section and whether turnover of services will also be included for 10 crore for the reasons I've already told you. The definition of seller is talks about turnover from the business. Therefore, those services are clearly not covered by 2061H. But for the purpose of turnover, for the purpose of applicability to the section, should I have to take the turnover of services? So whether the credit for TCS collected can be adjusted against your regular payment of tax? If yes, in which year the credit should be available? Because all of us know the credit for TDS is available only in the year in which income is offered for tax. So unless you offer the income for tax, the question of adjusting TDS does not arise. So will the provisions will be same here? If the provisions are same like this, so let us look at the very important challenge here. The TCS is recorded only at the time of collection. If I follow mercantile base of accounting, so where is the question of here been inclusion in the income, because the person collecting is the seller. I'm only going to be a buyer. It's the credit for the TCS is going to be given to the buyer only, because it's on behalf of the buyer. It's the collection is made by the seller. So where is the question of inclusion of income? So how the credit for TCS in such case is going to work? So those are some very interesting points. However, we'll just try to find an answer for this. Now, inner in 2061H, already the rate is only 0.1. Is it possible for him to apply for a lower rate of TCS? 0.1, or can he take like what we normally do in 197? Can he make a application for nil TCS or even less than 0.1? Already 0.1, the department considered to be very less, but whether it can be even lesser than that. So whether 75% of the normal rates, 3/4 the normal rates, does it apply for cases where PAN and Aadhaar number is not furnished? And whether sale to made STUs, I already covered this particular point. But the sale of shares subject TCS, this is a very interesting point. Interestingly, TCS, there is also a company in the name of TCS. However, it's so all of us should be aware of. So in times where we had VAT or sales tax, so there was an issue with the TCS has to fight before the Supreme Court on the losing cause, whether a sale of goods, whether it will be considered a sale of whether it's a software, whether it can be considered as a goods. So similarly, whether in the case of a sale of shares, can we say shares is a more property, because in the definition of sales of goods and sale of goods act, shares are also included. So that is also something, whether the shares, immovable properties, whether it's going to be software. So do they also have a question of TCS inbuilt into it? So when we just talk about TCS, we always name about India's largest software company. So they will also discuss that issue during the course of our discussion. So first on whether the payments received post 1st October 2020 for their sales made prior to 1st October also subject to tax. So the payments received post 1st October 2020 for the sales made for the period prior to 1st October 2020, this will be subject to tax collection also. That's a very interesting point. The section itself is applicable from 1st October 2020. But however, the section will apply only on receipt of the consideration for sale. So now the question which arises now, I have already made a sale before the applicability of the section. But in respect of such sale, I am receiving the consideration after the date on which section becomes applicable. Should there be a TCS? My humble view here is that the answer should be no. Now, why this issue arises? The issue arises because the obligation for the payment of TCS is linked with the receipt of the sale consideration. Now, since the sale consideration received post 1st October 2020, the view that could have been obviously taken by the department is there is an obligation to collect the tax gets triggered on such amount. This could be the possible view of the department. Because I'm just trying to say that on receipt of the consideration, the receipt of consideration happens from 1st October 2020. But however, just imagine, see you created an obligation to collect TCS only from 1st of October. Obviously, the section should be made applicable only not only for the sales which are made after 1st October 2020 and received. That alone should be the most logical point. So the payments pertain for the period prior to 1st October 2020 when the section itself is not there. Such receipts should not be subject to TCS. So that should be the more logical view. That's why I said maybe in my opening slides, if you make an observation. So whenever we try to clarify my experience in the last 30 odd years, so this is my 36th year with the subject. I started reading income tax in 1985, March 18th. So I found two things surprisingly. Once they try to come back and say we're going to simplify the law, then I always found they end up in complicating it more. So sometimes that's the way the word simplify appears in many cases. A lot of sections I've seen I can quote, but maybe today may not be the flow. Another point I just find, whenever they say that we are trying to clarify your doubts, that is where our doubts become manifold. So here, since the subsection states that additional amount is to be collected from the buyer, it is evident there should be a charge when the invoice was raised. Or we can contend that you can raise a debit note, it's a different story. So I am going to collect from the buyer without me charging him in the invoice which I raised before, without creating an obligation. Where is the question of me collecting the TCS? Or clarify in manner in which we can easily, anybody we can logically understand the section. But there is a clarification has come from there. Very interesting. What is the board's clarification? How will the adjustment made for the month of October? The seller in most of the cases maintains a running account. This is a beautiful way of saying, see, look, they are just trying to give a reason in such a manner where by saying it is applicable, they are helping us. That is something where I'm baffled by their answer. Now, see, you say you clarify the section will apply. That's different. But look at the way in which they are trying to give a projection. As a seller in most of the cases maintains running account at the buyer, in which such payments are generally not linked with the particular sales invoice. Oh, how can the CBDT presume this? How they can come back and say buyers are only maintaining running account? Or assuming a case where the people are maintaining running account, can you just penalize the people who are maintaining invoice? You have in tally, we can link it with invoice to invoice. Now, how you can generalize? Maybe you can come back and say if you are not able to have a match bill to bill, then you take the stand. But that is not the case. You just look at the way they are like, therefore, in order to simplify and ease of complaints. First of all, this itself is not any, the section itself is not ease of complaints. So therefore, having enacted a section which is going to trouble everyone, increase the complaints, and where is the question of ease of complaints there? Already you have created a section which is difficult to comply with, which is a needless increase at a time where the businessman is going through already enough stresses due to the current COVID situation. The best thing they could have done, at least the minimum effort they could have done, they could have deferred this section till 1st April 2021. That's the barest minimum you could have done. Having not done this, having been adamant on this particular provision to be introduced, then comes a very interesting clarification. See, I made a sale before the section was introduced. Where is the question of me collecting the TCS? But the way in which they're trying to give you, most of you are not maintaining bill to bill, you are maintaining a running account. Therefore, I am reducing your burden. I am reducing your, simplifying your complaints. It may be noted that this TCS provision shall be applicable on the amount of all sale consideration received on or after 1st October 2020 without making any adjustment for the amount received in respect of the sales made before 1st October 2020. Mandating the collector to identify and exclude the amount in respect of sales made up to 30th September 2020 from the amount received on or after 1st October 2020 would have resulted in undue complaints burden for the collector and also litigation. See, they are making this provision not for the sake of them. Wow, they all, you just for the sake of you and me. See, just the way in which they are trying to give, after creating a pathetic clarification, saying that is I'm doing for your good, is very, very unfair. So you cannot come back and say that all people are not maintaining bill wise. How do you just come to a conclusion? And therefore, for your benefit, I am doing something which is not in the spirit of the law. It's a very, very pathetic clarification, but be it is, that is a clarification. So therefore, we have to live with it. It is up to the SSC to decide whether they want to litigate on this particular point or they want to comply with it. Of course, their challenges here could be having not raised this invoice, and they have to now prevail upon the buyer to pay this additional amount. So that is something very interesting. We'll just come back on how to handle this as a practical situation. I will provide my suggestions. So whether the threshold of 50 lakhs is to be considered only from the sales made from 1st October 2020 or for the period prior to that also. So this is an expected clarification from them. We don't expect something different because many provisions right from I just remember when they introduced the provisions for TDS for the rent from 1/6/1994. So they specify, even though the section comes into effect in 1/6/1994 when 194I was introduced, the aggregate amount paid or payable during the financial year should exceed. So they clarified at that point that I'm talking about almost 25, 26 years before. At that point of time itself, they clarified, though the section is applicable only from 1st June, for calculating the threshold limit, we'll take it from 1st of April because the threshold limit talks about aggregate amount paid or payable during the financial year, where the financial year is April to March. So therefore, it was a logical expectation. Section uses the word receives any amount as a consideration for sale of goods exceeding 50 lakhs in any previous year. So the amount received from 1st April to 30th September obviously will also be considered for the purpose of determining the applicability of the section. However, the TCS will be required only on the amount received after 1st October 2020. So there is no doubt about this. This point is expected, and this is how the clarification on TDS is happening for the last 26 years. I'll take the amount prior to the applicability of the date for deciding applicable section. However, section will apply only from 1st October. So again, this is the very interesting point. So TCS will apply only on the amount received on or after 1st October. But for example, a seller was received 1 crore before 1st October 2020 from a particular buyer and receives 5 lakhs after 1st October 2020, would be required to collect TCS on 5 lakhs. That's a one interesting point. They say it is not on 55 lakhs because the total amount collected will become 100 lakhs before 1st of October, 5 lakhs after 1st October, which is 105. So you have a debt TCS recovered only on excess of 50 lakhs. Therefore, they said you don't have to do it on 55 lakhs. You do it only on 5 lakhs. A very good clarification, at least for a change. Will give them the credit for making this very clear. This will also confirm one of the other issue. Once I cross 50 lakhs, should I have to apply the TCS only on the excess amount or on the entire amount? Suppose if I go to 51 lakhs, should I have to do 0.1% of 51 or only on 1? So this clarification from the board is also very clearly makes it you have to start collecting TCS only on the amount in excess of 50 lakhs. So if it is 55, do it only on 5 lakhs. So that also got clarified over this particular point from the way in which they gave the example. So again, the equation, whether this we have already, the issue has already been circulated, we are only going to discuss now. So while calculating the turnover, gross receipts, sales for the preceding financial year in order to determine whether you should include the GST. So assuming you just put your sales as inclusive of GST without bifurcating, then obviously you should take on the entire amount. But if you are splitting your invoice separately into sales separately, GST separately, or just to borrow the guidance note on tax audit, So if you follow exclusive method versus inclusive method, that should decide in the case of turnover for this section also. So if the GST is separately accounted, so which is the recommended method by the ICAI, so then you will not include GST for the purpose of this. So having said this, there is no separate turnover definition in this particular section. This could also invite the litigation also. And again, as far as the point which I already mentioned, since the section was doing from the business, there is a possibility of the department taking a stand for the purpose of turnover of 10 crores in the immediately preceding financial year. They may contend that you should include the turnover of the business, which need not necessarily have to be confined to the goods, though the section is applicable only for receipt of consideration for the goods. For applicability on the basis of turnover preceding financial year, there is a possibility of they making a contention. The seller has been defined as whose turnover, gross receipts or sales in business exceeds 10 crores. So they may say, I have to only consider the business turnover or gross receipts or sales for the 10 crores. For that purpose, I don't have to differentiate between goods or services. Is it something a receipts of your business? Say, for example, if you're so if you are getting a sale of services, it is only a business income. So since the gross receipt should also be considered, the services by itself may not be subject to TCS, but there is a possibility of they trying to take a stand that for the 10 crore limit, I will consider that also. Similarly, they may also take interest income, which is a part of a business, should be considered as a receipt. Only if it is taken to income from other sources, they may say that it will not be considered as a part of gross receipts. So it's going to be a very wide definition they will try to apply for the purpose of this 10 crores. I think in my view, so since the section applicability itself is going to be based on receipt for the consideration of goods, this 10 crore limit should also be complied only for goods. You cannot have a situation where the applicability of the section is only for the goods, but the section itself is intended for goods, but you can't include the 10 crores goods, services, and everything out of your business. There is no logic at all. Maybe you can just recall those. Many of us will be familiar with the famous decision of the Supreme Court in 88HC. So export turnover by total turnover. The numerator and the denominator has to be same. You cannot have a situation where the comparison based of numerator and denominator different. So that the same logic will apply. The section's applicability is only for sale consideration for goods. Therefore, 10 crores should also be sale of goods only. You cannot have a different parameter for the applicability section and for the levy of the section. That's my humble view. So whether tax has to be collected on the GST amounts collected from the buyer or only the value of goods, this is a very interesting point. The simplistic logic which I would have applied. So the question is, should I have to collect TDS only on my sales or is it on the sales plus GST? Let's assume my sales is 100 lakhs. There is an 18 lakhs of GST. My total turnover is 118 lakhs. That is my total invoice value is 118 lakhs. Should I have to put GST of 0.1% on 100 or 118? So we'll expect the board to make a simplistic clarification here that it should be only on 100. That's what we'll expect them. How a GST becomes a consideration for sale of goods? GST is only a levy. But however, on circular number 17 dated 29 September 2020, no adjustment on account of sale return or discount or indirect taxes from GST is required to be made for collection of tax under 200C 1H of the Act, since the collection is made with reference to receipt to the amount of sale consideration. You got every point right, but still you are concluding wrongly. The collection is made since with the reference to receipt of sale consideration. How the hell GST becomes part of my sale consideration? GST is a levy, GST is a tax. You can't say that is part of my sale consideration. It's a very disappointing clarification. That's why I said it's better they don't clarify. At least we would have been much better off when they don't clarify. Now, So what is the way in which they considered in chapter 17b? Just recall that initial, just I think most of us, the senior members here, so will be aware. So 4 bar 2008 is the first time they clarified that service tax will not be included for the purposes of TDS. 4 bar 2008. But interestingly, the circular 4 bar 2008 was trying to talk about, it says applicable only for rent. It's applicable only for rent, they said. Now, the logic which they gave at that point of time was very interesting. In 194C, 194J, use the word sum payable. Therefore, Board Circular 715 clarified that you should deduct TDS on the gross bill. Nothing should be removed from the bill. Subsequently, after introduction of this 4 bar 2008, HIS tried to make a very interesting point that 194I uses the word the TDS at the rate of 10% or 2% on the income comprised therein. Whereas 184C or J uses the word sum payable to the contractors of professional services. Therefore, it will be on the full amount. Whereas since 184I talks about income by way of a rent, service tax is not by way of an income, therefore will not include. So only for rent, TDS will not be, service tax will not be included. However, for 194J, 194C, it will be inclusive of service tax. Rajasthan High Court recommended to them, your logic appears to be incorrect. Whether it is service tax on professional fees or rent or on contractor, the role of the person collecting is serves more as an agent, collects the tax on your behalf and remits. At no stretch of imagination, the service tax will be part of a professional fees. Service tax will be part of your contract amount. So therefore, extend the logic which you are given for 184I for other sections also. I think we must also complement the CBDT. They accepted the Rajasthan High Court and then issued a circular 1 bar 2014. So which specifically said the service tax component will be excluded for all resident payments. After the introduction of GST, the circular number 23 of 2017 also just continued to clarify the same thing. So GST will be excluded for the purposes of TDS under chapter 17B, provided the payment is made to a resident. This is chapter 17B, this is chapter 17BB. See how the concept changes for the same chapter. So when you have already taken a position for TDS, for all resident payments, for withholding tax, you don't have to include the indirect taxes. And then coming back and clarifying in September 19, 2020, just going back on your own stand that the TCS will be on inclusive of GST. Baffling. Chapter 17B you are saying don't include GST. For chapter 17BB you say it should be included. Except one is for the person paying the payment, other one is the person, the recipient. By principle, by concept, both are same. I always used to say that TDS is nothing but an indirect tax and income tax. TCS is also that. In fact, TCS more closely goes like in the lines of indirect taxes. Except in the case of a TDS is a minus. TCS works the same way with indirect tax. Anyhow, that is there. So if you want to be conservative, inclusive of do it. But if you are going to be aggressive, you can do it. But again, the question will arise now. When the payment is received proportionately, when the amount is not discharged in full, the question which will arise, how I am going to apportion the amount. Also, there will be challenges. So other issues will take one by one. So though it's already mentioned in the beginning, so we'll consider each one of them. So whether TCS should be included in the invoice or whether you should raise a debit note. It's a very common question I'm receiving from a lot of my clients. What should I do? So my suggestion will be always try to include in your invoice itself. That's more easier. You will have a better control. So normally when your accountant changes, the previous person would not have raised an invoice. So most of the your buyers will be settling based on your invoice value only. So if your invoice value is not going to include the TCS amount, expecting him to make a payment. He's not going to make an announcement. I'm going to make a payment tomorrow. Please raise a debit note for your TCS. I'll pay the total amount. I don't think no buyer is going to be interested. In fact, if you are able to collect itself, it's a big thing. So therefore, if you are not going to show it in the invoice amount, expecting the buyer to automatically include TCS also and make a remittance will be very difficult. Or he should call you and come back and say, boss, I'm going to make a payment. Please include your 0.1% also. He's not going to come back and say. Therefore, ideal situation should be you better raise it in the invoice itself. But however, if you feel that keeping track of it is going to be difficult, but I think you can go for a debit note option. If you feel that option is going to be better. So then the logical question which will arise now, if I raise a debit note separately for TCS, whether that will attract GST. So that could be an interesting point. If I raise a debit note, should that debit note carry GST? So I'm not suggesting those, but I'm saying that in the event of you choosing those, we have to logically have that question. Because if you're going to raise in the invoice itself, it's very clear. First 100, then 18. On 118, you will raise depending upon the aggressive stand you're going to take. So suppose if you put 118 and then you want to raise a separate debit note, then in those circumstances, whether you should also raise a debit note inclusive of GST. Again, for which there is a clarification from CPIC. So in their corrigendum to circle number 7650 of 2018, which is has clarified that TCS is not a tax on goods but an interim levy on the possible income arising from the sale of goods by the buyer and to be adjusted against the final income tax liability of the buyer. So therefore, for the purposes of your TCS, they say that you don't have to raise GST. There's no problem at all. No need to raise GST on your TCS if you're raising a separate debit note. So whether sale of services also covered in the section, the turnover from services also be included. So I think this already discussed, but still just for the sake of completion. The section does not cover services, but it is possible to contend that for turnover limit, services will also be considered. So whether the credit for TCS should be collected can be adjusted against a regular payment of tax. If yes, in which year the credit for same is available. So 206C subsection 4 specifically provides for this. Any amount collected in accordance with the provisions of this section and paid to the credit of the central government shall be deemed to be a payment of tax on behalf of the person from whom the amount has been collected, and the credit shall be given to such person for the amount so collected in a particular assessment year in accordance with the rules as may be prescribed by the board from time to time. I just simply said, well, the rules will tell you in which year you can take the credit. So rule 37I deals with this, and their sub-rule 2A specifically talks about the section. Notwithstanding anything contained in sub-rule 2 for the purpose of subsection 1F or 1G or 1H of 206C, but we're concerned about 1H only or 1G only, the credit for tax collected at source shall be given to the person from whom account the tax is collected and paid to the central government for the assessment year relevant to the previous year in which such tax collection is made. Simple. In fact, I have been advocating this particular point for TDS. It is absolutely illogical to me, in my view, in the sense in terms of simplicity. Give the credit for TDS also simply in the year in which the tax was remitted. So otherwise, the challenge which we have is that you have to carry forward the certain TDS because you have to adjust the credit only the year in which income is offered for tax. The client puts in previous in 1920. You are going to receive in 2021. Sometimes you don't receive in 2021, you receive in 21-22. See, so in those circumstances, the simplistic way of approaching could be as and when your TDS is remitted to your accounting, whichever year it is, but just like make it simple, like you have rule 37I 2A. That's the best rule even for TDS also. So instead of complicating which year you offered the income for tax, all the stuff carrying over the TDS, knocking off, all complexities can be avoided just by having the words similar to the top what we have in sub-rule 2A of rule 37I. So in the year in which the tax collection is made in that assessment year, you can take the credit for the TCS. So to that extent is a little bit more easier. Whether buyer can apply for a lower rate of TCS, unfortunately, this is dealt with by 206C, subsection 9. So subsection 9 very clearly specifies that you can apply for a lower rate of tax only for the TCS coming under subsection 1 or 1C only. So if you are in 1G or 1H, the two sections which we have been discussing in today's session, they don't have the concept of lower rate of tax. Similar to that of what you have in section 197 is what is 269 is all about. So, however, lower deduction therefore is not possible for both 1G and 1H. That means the rate is absolute. This is a very interesting point which I've been mentioning about. Whether it's 3/4 or 70% normal days apply the cases where PAN Aadhaar number is not furnished. A press release on 13th May 2020 very clearly specifies where the tax is required to be deducted or collected at higher rate. It will be non-furnishing of PAN or Aadhaar. For example, if the tax is recovered deducted at 20% under section 206W of the Income Tax Act due to non-furnishing of PAN or Aadhaar, it shall be deducted at 20%, not at the rate of 15%. So this is a press release on 13th of May 2020 due to the COVID situation to improve the cash flow. They say that it will be 70%, but they're very clearly saying that for 206AA will not be covered here. That is, if you don't submit the PAN number, Aadhaar number, you have to deduct the entire 20%. But this is only a press release. Maybe if you have seen the press release, you will find necessary legislative amendments will be made in due course. So it was made in due course by the taxation miscellaneous compliance law. So 206C10A was actually introduced to give effect to the press release. 20610A talks about in case of provisions of subsection 1H require collection of taxes owed during the period commencing from 14th May 2020 to 31st May 2021, then notwithstanding anything contained in these subsections, the collection of tax shall be made at the rate being 3/4 of rate specified in these subsections. Now, if you go to 206C1H, there they mention the tax rate is 0.1. Then the proviso says that the 0.1 shall be substituted by 1% if Aadhaar number or PAN number is not furnished. What 10A is saying, the rate specified in subsection 1H. What is the rate specified in subsection 1H is 0.1. And if you don't submit PAN number or Aadhaar number, the rate of specified in subsection 1H of 0.1% shall be substituted by 1%. Therefore, I am not submitted Aadhaar number or PAN number. Therefore, 0.1% is going to be substituted by 1%. That's what the proviso says. It is there in 206(1)H. It's a read 10A. In case the provisions of subsection 1H require collection of tax during the period commencing, so only 1H requires the collection of tax. The 1H proviso requires me to collect tax at a rate of 1%. So, can a press release override the law? Which is the principal legislation? Press release is not the law. The law is given by 206(10A). So, therefore, the high rates of non-furnishing of PAN number is contained the proviso to 206(1H). And hence it is possible to take a stand that the concession rates apply to such cases also. Don't go by the press release. The press release is there, but what is the section 206(10) is saying? That is what is important. So therefore, to that extent, the TDS enhanced rate is contained by a separate section after all the sections are over. But the enhanced rate in 206C or in the TCS are there in the proviso to the respective section. This point I have already discussed whether sales made to SEZ is subject to TCS, answer is yes. So whether sale of shares is subject to TCS, this was the point which I was earlier discussing about. The Board Circular 17/2020, I'm not sure whether it's really clarifying this situation or not. It says TCS will not apply to transactions in securities and commodities which are traded through recognized stock exchanges are cleared and settled by the recognized clearing corporation, including recognized stock exchanges or recognized clearing corporations located in international financial service center. So, by specifically stating securities transaction happening in the recognized stock exchange is not subject to TCS, is the board trying to preempt you that sale of shares other than done through a stock exchange subject to TCS? That's the question. Here it is a positive remark they are trying to make, the positive clarification they are trying to make. Sale of shares in stock exchanges or commodity exchanges to power exchanges does not require TCS. By this clarification, are they saying, I am saying by this positive clarification, am I come back and saying for sale of unlisted shares or sale of listed shares not done through the stock exchange, can we say that TCS will apply? That's the question. It's a very interesting part. They're not specifically answered with the sale of shares subject to TCS. They're only saying sale of listed shares in stock exchange does not require. Is the shares goods? The answer is yes. Under the Sale of Goods Act, yes. So is the clarification applies only to listed shares sold in stock exchange? Yes. And therefore, it is possible to take a stand that sale of shares other than mentioned in the board circular would attract TCS. So will sale of immovable properties subject to TCS? The answer is definitely no, because immovable properties are not goods as per the Sale of Goods Act. For the question of plain TCS, there's no bias. So one last point is that whether sale of software, whether it will attract TCS. So that's why I said the TCS itself, we can easily relate ourselves to the India's largest software company, Tata Consultancy Services. So they lost a case on applicability of VAT on sale of software. Software has been held to be goods, especially the off-the-shelf software which is available, it's considered as a goods. So therefore, in case the sale of shares, which is off-the-shelf shares, on which no TDS, because the provisions of TCS will not apply if the buyer is applying the TDS. So if no TDS is applied on the software by the person making the payment, in such circumstances, the reverse or the converse has to be true. So it is possible to take a stand that it's a goods, it will be subject to TCS. It's an interesting call, but in my view, because of the decision in the case of VAT, that software is a goods, so that stand could be taken for the purpose of TCS, unless there is a withholding tax done under section 194J for the software. So my final thoughts here, so since we discussed quite a lot of points. So every seller whose total sales gross receipt turnover business exceed 10 crores in the preceding year shall at the time of receipt of consideration for sale of any goods exceeding 50 lakhs from the buyer in the financial 2021, collect from the buyer not being a central state government embassy, consulate, local authority and importer of goods. So 0.075% up to 31st March 2021 as tax, hereinafter referred to as the tax collection source. So rate increases to 1% if the buyer does not furnish PAN or Aadhaar. There you can take a stand that will also be only 0.75 because of 10A. Provision for TCS only applicable on sale of goods, not on sale of rendering services. Provision of TCS is not applicable on export of goods. Provision for TCS is not applicable if the buyer is liable to TDS and has done so. Goods will exclude alcoholic liquor, tendu leaves, timber, any other forest produce, scrap, coal, lignite, iron ore, motor vehicle in excess of 10 lakhs. These exceptions are provided because 2061 it specifically says if the other sections of 1(1)(f) are covered, then 1(h) will not apply. So based on the clarification respective provision, logically and based on the principles, GST should not be considered as a part of sale consideration, both for the purpose of calculation and threshold and TCS. However, due to board clarification on a conservative basis, if you want, you can do the TCS in that also. So in case by the invoicing to a particular buyer exceeds 50 lakhs in financial 2021, but the actual receipt from said buyer is less than 50 lakhs, there is an outstanding receivable as on 31st March. No TCS is required to be done. So it's very interesting, very important. Your sale has exceeded 50 lakhs, but the actual receipts is less than 50 lakhs. Since the charging section very clearly specifies the receipt of sale consideration should cross 50 lakhs, TCS will not apply. where an invoicing to a particular buyer does not exceed 10 lakhs, but the actual receipts from the buyer is more than 50 lakhs on account of opening receivables plus current year sales. Applying the same logic, TCS will apply. You cannot take a double standard there. TCS will apply because the amount of consideration received for sale of goods has exceeded 50 lakhs. In a case where invoicing to a particular buyer is say 100 lakhs in 2021, an actual receipt from the buyer up to 30 September is 75 lakhs, and receipt after 1st October is 5 lakhs. Now the question is your TCS on 100 lakhs? TCS is on 75 lakhs, TCS is on 80 lakhs, TCS is on 5 lakhs. The TCS only on 5 lakhs because for the purposes of the 50 lakhs, I'll take from 1st of April, crossed 50 lakhs, therefore TCS will apply. The TCS will apply only on the consideration received after 1st of October. Therefore, the TCS will apply only on 5 lakhs. Raising debit notes on account of TCS in respect to outstanding balance on 30th September if 50 lakhs threshold has been crossed. Therefore, till 30th September, take your receivable balance, raise a debit note and send to the buyers. The debit note value will be the collection during April to September plus receivables as on 30th September minus 50 lakhs into 0.075, assuming that he has given the PAN number. So, preferably add a TCS as a line item in your invoices going forward from 1st of October. So, by collection plus receivables per current invoice exceeds 50 lakhs minus TCS in the current invoice should be charged at 0.075. GST in invoice to be charged on the basic amount only. But however, if again, as we already mentioned, GST, if you want to be very conservative, add the GST also for the purpose of your TCS. So you can try to take it as to a separate account, TCS provisional account. Once the collections are done, then go to the payable account may be credited. The month-end balances in this account should be deposited the 7th of the following month. Quarterly statements of TCS must be submitted in Form 27 EQ. And you have to file within 15 days from the end of each quarter, except for the month of March, where you have a time till May 15th. So you have to, the particulars of amount receipt on which tax has not been collected from the buyer on account of buyer have done either a TDS or buyer being specified persons, that also needs to be furnished. And the TDS certificate you have to provide in form number 27D to the buyer within 15 days of filing your quarterly statement. So this very quick final summary of what we discussed on this. I think the final thoughts, I'll just try to cover all the points which we discussed. So maybe I'll, before I go to the TDS, I'll take up one question which said the 50 lakh limit is per buyer limit. Yes, 50 lakhs is per buyer limit, whereas 10 crores is the entity limit. It's not the company's limit. So the distinction between the two is that 50 lakhs is a buyer limit, customer limit, whereas the 10 crores is the entity level or a corporate level. So now I'll turn my this thing to the second part of the section, which is the TDS changes. The topic itself is TCS and TDS changes in 1920 and 2021. So we'll now go to the TDS changes now. So 194N was introduced from 1st September 2019. So who is liable to deduct? Every bank, cooperative society engaged in banking or post office is required to deduct tax at source. The rate to which tax is recovered and deducted at the rate of 2% if the aggregate of cash withdrawn during the financial year exceeds 1 crore. So basically 194N, which was introduced in 1st September 2019 and subject to has also been modified now. So there are certain exceptions which are given, so to whom the TCS will not apply. But this section underwent a very interesting change from 1st July 2020. The section itself was introduced only 1st September 2019. So amid this COVID period, so they made a very interesting change. So the change is not on who is liable to right? So when a person is required to deduct TDS under 194N, so if you look at the earlier section, the time of payment, threshold limit for applicable to the section and the date of TDS. This is where the change was made from 1st July. So within what do you say, September to March, which is about 7 months, and then you have 3. So within 10 months of the birth of the section went for a sweeping change. So they say if you don't file the tax return for all the 3 previous years preceding the previous year in which the payment of such sum is made, 2% if the amount paid exceeds 20 lakhs but does not exceed 100 lakhs. 5% if the amount paid 100 lakhs. So in either case, 2% of the amount exceeds 100 lakhs. So when you talk about any other case, we are talking about you are not covered by the previous situation. So if return of income is not filed for all the 3 previous years preceding the previous year, such payment of such sum is made. So therefore, if not filed for all the 3 previous. So for unless you have not filed for all the 3 years, it is possible to contend that this particular section will not apply. You will come under only the second part of the section. So there seems to be 2% between 20 lakhs. So up to 20 lakhs, in any case, there is no problem. 20 to 1 crore, you will have 2%, and then above 100 crores, 5%. That means the 2% limit, which is applicable for the people who are filing their returns, that is made applicable for persons who have not filed the return with a reduced limit of 20 lakhs to 1 crore. And for those who have not filed the tax returns, if the amount exceeds 1 crore, instead of 2%, they will be subject to a TDS of 5%. The question which arises, how a bank or a post office or a cooperative society knows that you have not been filing the tax returns? Should they have to take an undertaking from them? So a lot of questions were raised on this particular point. So the So this is a very interesting point what they are trying to come back and say. So I think this is the way in which possibly instead of trying to discuss in a very complex manner about how do we know they file the returns and how to apply, the simple way of applying that rate of 2% between 20 lakhs to 1 crore and 5% above 1 crore will be this press release. So what the CPDT says, we have provided the TDS applicability utility. So what you do is you simply check verification of applicability 194M on the income tax filing. So therefore, click that. That will be your basis. So therefore, the non-filer returns point will be provided by the CBDT or provided by the utility. So therefore, typically a bank or a post office, you don't have to really find out whether the section will apply or not. Go by the complex route, all the 3 years, what is the meaning of all the 3 years, whether current year will be included, all the stuff, don't waste your time. We are providing a utility, go to the income tax India filing site, just put this point, verification of applicability, that's it, simple. So therefore, I think that is the simple way of approaching that rather than the complex discussion relating to that. So obviously the idea seems to be the cash is something which definitely has to be killed. So because they want more transparency and more audit trail to be left, they are doing everything possible to ensure that the cash transactions are penalized in all forms, be it in 4480 or 483 or 2690SS or 2690 or 2680. By various mechanisms, we are just trying to move to a more a system wherein everything can be tracked, everything is accounted, everything is broad and wide. So that seems to be the very novel and great idea behind this. That's one more reason why this 184N would have been introduced. So already, as mentioned in the previous case also, the section will apply once the amount exceeds 20 lakhs or 1 crore. So again, so at the rate of 2%, if the aggregate of cash withdrawn during the financial exceeds 1 crore, so once you cross 1 crore, obviously the question of when do you apply the section. The same principles which we discussed for 206C1H will equally apply for 194N also. So the one So once you cross 1 crore, then the same logic will continue. Again, whether it should be applied in the entire amount or only in excess. So I think the same principle which we suggested for 206C1H can also be equally applied for this section also. So a couple of other points relating to 194N. So whether this will be considered as an income, because all of us know under 198, the tax deducted as source should be considered as considered as income deemed to be received. Now what's the income element here? So this is the basic problem. So it should 194N should also be challenged on the basis of the constitution validity. The answer is maybe yes, because where is the income element here? So I withdraw my own money, that amount is never going to be considered as my income, and therefore for withdrawing my own money, so where is the question of income element in that on cash withdrawals? That's the question. So therefore, again, this could be tested on the basis of constitution validity, whether you can collect TDS on something which is not going to be considered as income. So whether you can collect tax on something which is not taxable. So that is a $1 million question. So they bravely enacted a section and they bravely widened the scope of the section. Let's see that whether this section is challenged on that ground and able to survive the challenge. But however, they are just maybe the one difference that the department could take here. So they say that we are not taking the withholding tax as an income. So 198 very clearly specifies the amount of TDS deducted in the 194 and it's not going to be considered as income deemed to be received. The second issue which arises is whether you get the credit for TDS for the amount paid, because no income is going to be offered for tax, because as all of us will be aware of, 199 very clearly provides that you will get the credit for TDS only in the year in which the income is offered for tax. Here, there is no income. So where is the question of me offering the same for tax? And therefore, how will I be allowed the credit for the TDS? So again, they made the changes in the rules. The credit will be available in the year in which the TDS is deducted and remitted. So therefore, at least they may go and defend. So we have definitely ensured the two problems with the assessee may say, we have considered that. We are not saying the TDS deducted as income. And again, we are also allowing the TDS irrespective of the, since the income is not going to be offered for tax, and still we're going to give the credit for TDS in the year in which TDS is deducted and remitted. But having said this, the only question which needs to be understood here is that since it is not an income, where is the question of withholding tax? The government obviously in many occasions has specified that they have a good tracking system, they have a artificial intelligence, they have a software. So all the assessments and other things are going to be based on the risk-based technology aided, artificial intelligence aided. So when you have so much of technology, when you have so much of capabilities which you have been talking about and which you may also possess, do you need a TDS to still further track? That's the important question. So because already you have enough technology related products, machine learning, artificial intelligence, many things are available at the disposal. And we also need provisions like 194N, which defines the basic premises of the TDS, which basically intended more as a prepaid taxes. So should we have to have this? Anyhow, that is a section where somebody will challenge this on the constitutional validity. So we'll wait for it and find out whether it actually succeeds or not. So another interesting section was introduced last year, because as most of us will be aware of, the individual or HUF are required to deduct TDS under section 194C or J or H only if, so in the case of 184C, if they are subject to audit under 44AB, Whereas in the case of 194J or H, if the monetary limit under clause A or clause B of 44AB is going to be exceeded. So it's a very interesting amendment they made across all the sections. Now they said that the section no longer makes a reference to 44AB. It only talks about the turnover should exceed 1 crore for business and gross receipts should exceed 50 lakhs for profession. So that is a change which they have made in other sections also. So if a contractor, if an individual constructs, say, a residential house, since it is for personal use, TDS will not apply. If not subject tax order, TDS will not apply. So therefore, they introduce a new section, so which says that if your aggregate amount paid for contractor, professional fee, and commission of brokerage, and if you are not somebody who is required to deduct TDS under 184CJ or H, then you have to deduct TDS under this section at the rate of 5%, provided the aggregate amount paid in the financial year exceeds 50 lakhs. So if it exceeds 50 lakhs, there is a 5% TDS for individual HUF who are not required to deduct TDS under 184C, I or J. So basically the non-tax audit cases and wherever the payment is made for personal purposes, so just want to cover this. This is a very important amendment. So currently you can submit form 16A for resident payment. Suppose I make a payment without deducting tax. So in such circumstances, so whether the assessee will be considered as an assessee in default, especially in the case where the deductee has included in income and has paid the tax. So whether in such circumstances, the question which arises now is whether the TDS can be also collected whenever the deduct is already paid. So the decision of Supreme Court in Hindustan Coca-Cola, where Supreme Court said TDS is only one mode of recovery as per 202. So once the recipient has included income and has paid the tax, you cannot again recover from the deductor. So therefore, once the recipient paid the tax, you cannot once again recover. You cannot doubly enrich yourself. TDS is only one mode of recovery. The recipient has already included paid the tax. You cannot again recover the TDS also. But for some very strange reason, when they want to include the decision of Supreme Court by putting some checks and balances, they say that let this be certified by the chartered accountant of the deductee that this amount has been included as income and has paid the tax and has also furnished a return of income. So if you comply with Form 26A, then the assessee will not be considered as an assessee in default by virtue of 201 proviso. But the 201 proviso was applicable only for resident payments earlier. So a lot of consultants strongly rely on Article 24 of the double taxation avoidance agreements, which provide for a non-discrimination. So you cannot discriminate between a resident and a non-resident assessees with their operating under identical situations. So if a payment made to a resident without deducting TDS is not going to be subject to an assessee being considered as in default on account of Form 26A being submitted. So why not a similar point been extended to the non-resident by applying Article 24 of the double taxation avoidance agreements? So since there are many courts are in favor of this invoking of Article 24, so 201 proviso was amended now to specifically provide that instead of the word sum paid to a resident. So this was earlier they were saying any person who fails to deduct. This was, if you see the word which I have shown in bold, resident is a wording, but this is a pre-amendment and this is what they have done. So they have changed the word resident with payee. So they also made a corresponding change in 40A, which was earlier there one in 40IA. So that means today the disallowance will not be attractive for both resident and non-resident payments if the conditions of 201 proviso are satisfied. Earlier, only for resident payments, Form 26A you can use, but today you can use both for resident and non-resident payments. But one important point, whether this particular amendment can we take this as a clarificatory in nature, and therefore it will retrospectively apply. That is one more stand which you should consider. In my humble view, it is possible for us to take a stand that this amendment made from assessment of 2020-21 in 40AI and in 201 proviso should be considered only as a clarificatory in nature, and therefore, in my view, should be considered as retrospective. That is my humble view. There are a lot of provisions on these lines have been considered like this. Without going into the details of that, definitely I just would like to bring this particular point. Not only this point amendment is applicable for 40I from 2021, you can also take this amendment as retrospective. So this I will skip the limit under 194A, which is made by Finance Act number 1 of 2019 from assessment 2021. This is a very interesting amendment, therefore I'll spend 2 minutes on this. So 194DA, so basically provides for TDS on insurance policies which are not exempt under 10AA, the amount exceeds 1 lakh. And the TDS is deducted at the rate of 1% on the proceeds of the policy. Again, there is a mismatch was noticed between what is offered for tax by the SSC and what is reflected in 26 years. So let's assume I get 5 lakhs, but before offering this income for tax, I can reduce my insurance payment. So just to take a very simple example, so if I make a payment of life insurance premium where the policies of the premium paid, so if it is so one of the conditions in ATC is that your premium paid should not exceed 10%. So if the premium paid exceeds 10%, I get ATC only to the extent of 10%, but the amount received on maturity of the policy is taxable. So how do you track this? That's where this 194DA was introduced, to track those policies where on maturity which is taxable, there is a withholding tax made applicable at the rate of 1% if it crosses 1 lakh. But the challenge here, in this particular case, the challenge predominantly was, I offer for tax the amount of maturity minus insurance premium I have paid. And whereas in 26 years, what is included is a gross amount and 1%. Therefore, there is a mismatch notice between what the SSC files as his income and what has been reflected in 26 years. So therefore, what they have done is because we are going into the concept of pre-filled income tax forms, and there should be minimum effort from the SSC. So that's the kind of trend we are going. So where everything is going to be pre-filled and we have to only modify some numbers. So we given that idea, that is where we have the tax audit has been done 1 month before your filing of tax returns and so on and so forth. So therefore, they just wanted to make a change that, so instead of 1% on the gross amount, you have to deduct 5% on the net amount. So the idea began as to match your amount shown in your income tax return vis-a-vis what is reflected in Form 26As. So the amendment was made from 1st September 2019. So where 5% of net as against 1% of gross, so that your 26 years and what you file can be matched. So it's a very simple amendment, 194I, therefore I'll skip that. So 184IA again went for a major change. The 184A is a very popular section where there is a withholding tax of 1% on purchase of immovable property in excess of 50 lakhs. So here the one issue was whether the consideration will include club membership fee, high-rise fee, car parking fee, and other facility, whether those are covered by 184IA. So they specifically expanded or given the meaning of consideration from 1st September 2019. So where they specifically say the consideration will include not only the amount charged for the building, other incidental charges charged like membership fee or car parking or high rise, and all the fee will also be included for the purpose of 194IA. But since the consideration has been defined from 1st September 2019, it is possible to take a stand till 31st August 2019. Consideration will not include for these services. It will include only for purchase of immovable property. And there is also another issue is the project is completed before 1st September, but you are going to make a payment after 1st September, whether you had to withhold the tax for those amounts also. The answer is yes. If you're going to make the transaction payment, credit or payment after that date, we should include the consideration for that also. So, with that, I think I'm almost done. So I also maintained the time allotted. So now I'll thank you very much for your patient hearing, and so I hand over the proceedings now back to the chairman, and I once again thank branch Ernakulam branch, for providing me this opportunity to share my views. So, despite the fact that it's been 3 5 in the afternoon, the topic definitely is so. This thing is definitely will make you wake, raise your hands, and then find out so many issues are there, and the clarifications have only added to the complexities. So I once again thank all of you for a patient hearing. Thank you, Chairman. Thank you all the committee members of the bench and all the senior members who have been present in the program. Thank you.
Is there any questions or queries? I don't think, nobody raised any questions, separate questions. I hope there is.
One question in Q&A. It's about how do we reflect TCS in our invoice?
I think I have already walked through.
Yeah, explained. Yes.
Yeah. I've done that.
No other questions, I think.
No other questions.
Whether I think it's maybe because of the so complex nature of all these TDS and TCS portions, or else. Anyway, I think, sir, it was a very lucid presentation of all important portions, particularly the new portions and the TDS portions, the TCS on sales, or also now the TDS on contracts and everything. So all those changes, and you very briefly explained everything minutely itself. I think so. Those needed with the detailed explanation, and even examples also you given. It was an excellent presentation. Probably, I feel that TDS and the TCS portions members may not be that much. Not very. No, I'm not saying that they're not thorough with it, but I think there may not be much confusion as such, except that this new portions which is came